Hello and welcome to your Global Markets Technical Outlook for the end of Q3 2024. The material in this presentation is general in nature and should not be construed as a recommendation to buy or sell any financial instrument. Always consult with a licensed financial advisor before deciding if any investment is right for you. So let's dive straight in to the US stock market, and on the monthly chart on the log scale you can see there we're still well in the middle of this very well behaved trend that's been going on since 2009, since the end of the financial crisis. We're now above that 5,000 level. That was a key level, and as you'll see as we drill down into the weekly chart, we did sort of bounce back, just find support I should say at that 5,000 level, and we've taken off. However, that doesn't really tell the full story, because as you can see for the last few weeks on this chart, things have started to turn a little bit more volatile than they have been. When you look back through this section here, we can see the market was very well behaved and now is starting to turn more volatile. So what does that mean? Well, we know that tops are formed when the market starts, can be formed when the market starts increasing in volatility. And if we look back to what happened at 2007, we know that the market was similarly well behaved, then started to get much more volatile before it finally collapsed. I'm just wondering if we're somewhere around about here where we're just seeing the first instances of that volatility coming in. But always keep in mind, there is a lot that can happen between now and if and when the market eventually turns bearish. It took 10 months for this topping pattern to form back in 2007. So it's certainly not, the increase in volatility is certainly not a reason to be bearish right at the minute, but you should certainly keep that on your horizon. Because as we'll see on the Ichimoku chart, the market is still very, very bullish. We're well above this cloud. The Chiku span or lagging line is well above the cloud also. So that is unequivocally bullish still for this market. So while we're short-term bullish, we may be seeing some more volatility. Let's have a look at now at the market internals and see what they're also telling us. On the bullish percent index, you can see that the market down here at the bottom has certainly been rising, but we're starting to see that divergence come into the market where we're no longer making those peaks up around the 80 level, and we're currently sitting around 64% of stocks bullish. So that's definitely a type 1 type of divergence there, with the market going higher and the market breadth starting to move lower. These things can take a long time to play out though, so again, it's not really a reason to be bearish right away, but certainly something you should be aware of. And on the stocks above their 200-day moving average, we're also seeing some divergence here. Not quite the same level of divergence as the bullish percent index, but we're seeing the market breadth moving sideways. 62% of stocks still above their 200-day moving average, but again, we're not seeing an increase in the size of those peaks above that sort of 72, 73 area. So some sort of type B type of divergence coming into this indicator of market breadth. On the discretionary versus the staples, this had been rising up until about the start of this year. The markets obviously continued to rise, but we're now seeing the drop in this discretionary versus staples ratio. So that is, this discretionary versus staples tends to be forward looking. So again, that's one reason just to be a little bit more cautious as we move into this next period of the market. Same on the semiconductors, which you could say is the thing that's really been driving this market higher. This is kind of the AI story. Everybody trying to get their hands on these graphics processors that are used in these large AI models. And as you can see, once again, this had been rising really steeply and backing up the direction of the market. But more recently, we're starting to see that ratio differ now, where the stock market or the S&P 500 continuing to make way, but the ratio between the semiconductors and the market itself starting to fall. However, on the advanced decline line, we're seeing that break out into new highs. So we are still seeing advancers in the market, and that's carrying this to a new high. So that's still indicates bullish sentiment is around for the market overall, and the stocks as a group may be quite bullish, whereas the heavyweights, these big growth stocks, the AI stocks, are probably the ones that are weighing a little bit more on these other indicators. Looking at the relative performance of the index year to date, we can see the S&P 500 still leading the charge, up around 16%, the Nasdaq around 14%, but you can see we were up at 22% ahead for the Nasdaq. That's now back at that 13 or 14%, so we've dropped off a little bit, and you can maybe just pick out the pattern as these two big indexes start to move a little bit more sideways. The Russell, by contrast, had been bringing up the rear and then turned very volatile in the last 3 months or so, where it popped and then dropped, and it's kind of wiggled around, and it's now sitting up 4% for the year to date. And the yield curve, as we know, is still showing this very steep inversion, and that is probably what's keeping a lid on more rises in the market. The short-term rates being so high sucks money out of the stock market and into less risky assets like bonds. And one reason for the short end of this curve being so steeply inverted, of course, is that the Fed rate is still so high by comparison to the rest of the yields. And with the expectation is that we'll start to see the Fed start to cut in the next couple of months. That will bring the short end of this curve down, and that should start to solve this inversion conundrum. Because what does inversion mean? Well, it's often precedes a recession in the wider economy, in the US economy we're talking about here, of course. And the odds currently of a recession in the next 12 months or so is still sitting up at 52%. So it's still a coin toss whether the US tips into recession or not. Elsewhere on the sentiment indicators, we're looking at the put-call ratio still being very much in the middle of its range. We saw that it did dip down, just sort of scraped into this bullish extreme down here. That's perhaps when we started to see that volatility coming into the market a little bit more. Now we've had that sell-off, that's kind of unwound itself, if you like, and we're back in the middle of the range again. So no sign of sort of panic or fear at this point. And by the same token, there's no sign that people are very, very bullish at the moment. So maybe that indicates we're back into this a little bit more sort of sideways progression at the moment. And on the VIX, well, you no doubt were aware of this sort of mini Volmageddon, as it was called, that we had a few weeks back, where the market just kind of tipped over, and the VIX popped to an unseen level, the highest level that we've seen since COVID, certainly, up here around about that 65 level. So that was a bit of a shock when everybody saw that. But as you can see, that was quickly resolved, and we're back now in this very low risk area. So once again, that indicates that there's no immediate panic, there's no high demand for protection for stock portfolios and so on. So we'll maybe just see the market continue to plod sideways, or maybe scrape into making a new high. But at the moment, there's nothing indicating that we're ready to drop off to the downside. But there is a little bit of fear around. You can see this fear and greed index that we looked at last time was sitting around here in this neutral area. It's now tipped over. It actually did dip down into extreme fear during the quarter. It's back here around fear. But as you've seen, everything else is showing us that there is low risk in the market. So this could actually be a short-term buying opportunity here. But all of those conflicting signals, I guess, made me think maybe it's time for us to revisit our infrequent series of where to from here. So let's have a look at the case for the bulls and the case for the bears and where we go from here. So certainly on the bullish side, October tends to be the month when a lot of big rallies begin. So it has the highest number of 10% rallies since World War II have started in October. So that's one reason to think that maybe, we sell down into that sort of late September, early October period, and then we take off from there. Also having the wind in its sails is the last quarter of seasonality, and we'll come on to the seasonality charts in a minute, but this is just looking at the S&P 500 seasonality for the last quarter or so, and you can see that sort of end of September is when it tends to dip out, and then we sort of end up moving towards that Santa Claus rally phase as we get closer into the festive season. So that's on the bullish side. The other interesting thing is to look at, well, what happens when the Fed start cutting rates. Now, there's a high expectation that is what we'll see in the next couple of months. And so you can see here that one of two things tends to happen, and it really depends on whether there's a recession or not a recession. So if there's not a recession, which technically there isn't at the moment, the market can be very bullish. However, if we do tip into recession, then it's more likely to be bearish. And this is perhaps been influenced by the number of bear markets in that period, because the Fed tend to cut rates as they go into bear markets. So this is probably a 50-50 shot for the bulls and the bears, depending on which way we head. But on the more bearish side, we are kind of historically overbought. There's no doubt about it. This market has been going up for a long time, and Goldman Sachs produced what they call the bull bear market indicator, and you can see that these blue shaded areas are bear markets. So you can see when we've come up into the 70 area, that's tended to be a spot that's preceded these bear market periods, and we're sitting right up there again now. So that's a case for the bearish side. The other case for the bearish side is that we're seeing the end of the dollar yen carry trade. So again, that whole Volmageddon episode was basically caused by the Japanese central bank putting the interest rates up from negative to a little bit above positive, and that had the effect of squashing that carry trade that's been going on with people borrowing in yen and buying US dollars, or buying these growth stocks in the stock market. So now that trade is being unwound. That's affecting the cross rate of the dollar and the yen, and it's also you can see how highly correlated the S&P 500 is with that market. So depending on what happens with that carry trade, whether people decide there's still enough fat in it that they want to re-engage, that could help the market. But if there's more unwinding of that carry trade, which is massive, we're talking trillions and trillions of dollars, if that starts to unwind a little bit more, that would be bearish for the market. But moving on now to the seasonality itself, and there's that S&P 500 seasonality. Here's that section over here in the last quarter is the bit we were zooming in on a moment ago. You can see how bullish that tends to be. It's a bit unclear whether we're following it exactly this year or not. We did have that dip back in April time, which kind of matches the dip that we see on the cycle. However, we've had this volatility come into the market that's not really reflected in the cycle. So it will be interesting to see where we go from here and how that affects things as we go towards the end of the year. The month-by-month seasonality does show us that September tends to be the most bearish month, and that would line up exactly with what we're experiencing in the last couple of weeks or so. So it wouldn't be any surprise to find out that we end September down. But as we can see here, October, November, December all tend to be very bullish as we head towards the end of the year. And of course, we are in the election year. We did have the sitting president running, but that is no longer the case. He has dropped out, and it's hard to say whether you would call this an open field. Some people say, well, Donald Trump is acting like an incumbent. He's the former president, and so on. So I'm not sure which one of these lines we should be following. I would tend to sort of lean towards this all election years, the black line, either that or the open field. If we chose to follow this black line here, then again that tends to be more bullish as we head in towards the latter part of the year. So the US election falls in early November, so we'll see what happens as we come in close to that. Moving on now to the Aussie stock market, and on the monthly chart, well, this market is very bullish at the moment. It's taken a long time to get its act together. It's spent a good couple of years in this sort of sideways bunching up here and underneath 7,600. It's now shot through that level and it's now cleared that level. It's even come back and retested it as support, and it's back up very close to its all-time highs. So very bullish for the Aussie 200 on the monthly scale. On the weekly scale, you can see that a little bit clearly here. Here's that sort of 2-year sideways action. Then we got the breakout in early 2024, come back, retested it. It's actually come back, retested it again and bounced higher. And then we're now sitting up very close to those all-time highs once again. On the Ichimoku chart, well, there's no question that this market's very, very bullish at the moment. It's well clear of its cloud, and the lagging line is rising. The cloud support coming in there around about 7,400 for the Aussie 200. And if we compare it to the other global indexes, then we can see that it's actually, although despite the fact it's been very bullish, it's a bit of a late sprouter, if you like. So it's only made it to about 4% up for the year. The Hang Seng is the only one in our area that's worse, down around about 0. Then we've got the Nikkei here, which was blasting way ahead up at 26%. It's now turned a bit more volatile and it's sitting back at 6%. And then we've got the Indian Nifty and the S&P 500, both around that sort of 15-16% mark. On to the currencies now, and the dollar is weakening. There's no doubt about that. We know the reasons for it, because the expectation is that the Fed will start cutting rates. That's bearish for the US dollar. And this 100 level on the dollar futures index is now the line that it needs to defend. Should it go through that level, which I think would be where the probabilities would lie, then we'd be looking back at 90 as the next level of support. But in the meantime, it's very sideways for the dollar. And the Aussie dollar has been getting a little bit wind in its sails, just sort of short term there, because of that weakness in the dollar. And if the US dollar weakens anymore, then that 70 level would be the next one that's under threat as a level of resistance. And if it can get back above that, then could even make more headway back up towards that 80 level. On the euro, well, that 105 level was the level to hold, which seems to be still holding, and this downtrend line here, which is goes all the way back to the mid noughties, is coming in just ahead of it, around about that 112 area. So I expect if it gets up as high as that, which it likely will if the US dollar weakens, then we'll see whether it's able to break through that level and head for 120. And on the Japanese yen, it doesn't look like a very big move down here at the end on a monthly basis, but that was the thing that broke the back of that dollar yen carry trade, and you can see that it's it managed to hold that dollar, that 0062 area, which was kind of make or break, and it's bounced back up. So short-term bullish for the yen, certainly. And once again, if that carry trade continues to be unwound, that's going to be even more bullish for the yen as those yen loans get repaid. And the quarterly chart, just to sort of put a fine point on it, you can see that support level went all the way back to 1990. So that really was a key level. And for now, at least, it's managing to hold it. On the Bitcoin, on the weekly chart, well, it's come off a little bit. That 69 level looks to be a level that is proving tough as an area of resistance. You can see it's now producing lower highs and lower lows. Even Donald Trump's performance in the debate managed to make it sell off a little bit. So it's back in the middle of the range here, and there's no real obvious line of support. I guess the 50,000 area would be a key level just psychologically as a round number. Which it bounced up from just recently here. But 69 really remains that level to try and get across as for the Bitcoin. And wrapping up on the commodities, and the big story, I guess, is the weakness that we're seeing in oil. This continues to head lower. We're now seeing lower highs and lower lows. This kind of descending triangle kind of formation or symmetrical triangle, which it's already broken, you could make a case for. And 63, I think, would be the key level for this market to either hold. Perhaps a weakening dollar will help that situation. But for the moment, crude looking very weak. Iron ore. Beg your pardon. Copper is the next one here, and you can see on the weekly chart how it blasted off and went right through that level of $5 a pound, but sold off almost immediately all the way back. And interestingly, it made it all the way back to this sort of symmetrical triangle breakout area that it broke through around about the $4 level, and it's now bounced up from there. So it's kind of, you'd have to say short-term bearish, but more or less sideways, I would call it, for copper. And finishing off on iron ore, weakness in the iron ore on a weekly chart here. It didn't manage to hold that 130 level at the start of this year. It sold off, and it looks to be heading for that 80 area. Obviously, the slowdown in the Chinese economy is the biggest story for iron ore. So that continues to slide lower, heading for what looks to be support at 80. And I always like to wrap up on a high note, so let's go out with gold, which is really still powering ahead. Took off through that 2087 level and has just kind of pounced higher. It's now up at 2,500. So looking very, very bullish for gold. Again, the weakness in the US dollar is probably going to give it a little bit more of a tailwind as well. So a lot of people say it's a hedge against inflation. As we know, global inflation has been high as well, so it's probably no surprise that gold is up where it is, but certainly bullish for the gold. I guess the only thing I would say is it's starting to look a little bit overdone to the upside, so we would expect maybe some consolidation or at least a pullback for the gold. So just to summarize that, US stocks certainly look still very strong. I certainly wouldn't want to be trying to short the US stock market at the moment. But as we can see, that volatility just starting to increase, and we're also seeing those divergences in some of those breadth indicators. So just something to be aware of on the US stocks. The Aussie 200, of course, looking very bullish. We saw that big breakout above 7,600, and that seems to be holding. On the currencies, well, US dollar and the Bitcoin tend to be the two weakest ones that we're seeing, and that's giving some of the others strength that elsewhere. And on the commodities, well, the oil and the industrial metals certainly looking weak. Gold is certainly spiking higher. Perhaps a weaker US dollar will start to help some of those commodities. Checking in with a couple of the strategies that I trade, and the Monterey Nasdaq one. Well, it was way up above 30% for the year, which was well above average. That latest sell-off's brought it back to about 18. It's still well ahead of what the index is doing, and I would expect as we see the market start to edge sideways or higher, that will do that system no harm. So I'm quite happy with that one. And then Dolphin, well, we just had another trade come through for this one. It's back, and it's actually made another new high just this week. So very happy with both of these. If you want more information, check out smartsystematictrading.com. And with that, I will thank you very much for your time. Wish you good luck and good trading for the next quarter, and bye for now.